right, we're live. Well, awesome. We're sitting here with David Swain, Matthew Fitzgerald, and then we have with us, joining us safely but virtually here, Travis Cavanaugh, with a. So we're gonna put this out on our podcast, but we had all been talking. We've been connecting together on a regular basis and wanting to get some information out there to the general consumer, what's happening in all these different markets. So, of course, David Swain, our real estate professional, the Northern Arizona real estate professional, Matthew Fitzgerald with Holistic Planning.
Correct.
I nailed it. So yeah, big switch for him. New brokerage, new opportunities. Brokerage is still the right name for that, right? Or is that not the right word?
I'm not in the brokerage industry anymore.
Ah, okay.
So I'm in the registered investment advisor industry.
I knew as soon as I said brokers, there was something wrong with that. So financial advisement industry. And then, of course, Travis Cavanaugh with Stevens and Co.
CIA?
RIA.
Oh, okay. Certified investment advisor.
Yeah, exactly. So let's. I thought it'd be really fun here to just kind of kick off and just kind of everyone riff on what's happening. I mean, it has been a wild year, not without lots of things to talk about. And of course, I probably would disclaim as we put information out there to people, we are focusing on helping people be successful in the realm of these different asset classes or in the different planning stages of tax and financial preparation. We're not making political statements on this. So when we talk about that type of stuff, like people, please take it with a mature grain of salt, right? We'll talk about how policies impact those markets. So even though I know there's a lot of hot button on the political sphere right now, but yeah, so maybe kick off, David, for us. New father as of 3 to 4 weeks now. David just had his first little baby boy, and you're getting some sleep. You're doing okay?
Barely, yeah.
And you were just telling us that
most nights.
Yeah, you were just telling us between some market situations and conditions, and also the family life, that you thought things would cool down, but you're actually seeing things move. That's good to hear. So let's talk about it.
Well, yeah, I've kind of been feeling that with the surrounding realtors as well, that there's a good healthy amount of buyers that are kind of jumping into the market right now. You try not to focus on your micro world too much to assess what the overall market is doing, but I observe that at least every other week by doing a market update, and just checked that today, and we're seeing that I think we've reached the peak of season and kind of leveled off with current inventory up here. So we've been observing more sellers than buyers throughout this year. Largely because of interest rates and I think uncertainty with the economy. But things are still moving, right? If we only sold 3.8 million houses nationally this year, while that's slower than we've seen in quite a few years, that's still a huge amount of activity. There's still life circumstances that are creating those opportunities. And, builders are slowing down, but they're not stopping building in most cases. It's just people are, I think, being a little more cautious overall. And, I think that it's more or less a balanced market. If you look at the Phoenix market, it's easily turned into a buyer's market. I think their inventory is somewhat leveled off as well. So they've kind of peaked around 27,000 available listings.
Okay.
And, we're just waiting for those interest rates to come down to about that 6 mark, is my opinion, to stimulate it. They've eased a little bit. I'm sure you could talk to that in the last, 4 to 6 weeks, but not enough to really get people excited. I think the activity that we're seeing with the new buyers is not from that. It's just life circumstances. So that's what I'm observing. I think we'll have another good couple months of the main selling season for Flagstaff, and then we'll kind of go into our natural, slower fall season.
Fair enough. We talked. We'll get everyone's hot take and then ask. So I have so many questions on where we go from here. But no, I'm glad to see that you're seeing a fairly balanced take on it. Are you seeing any particular hot points in the market? Like things are still selling pretty quick on any particular in price tier inventory, or is it pretty much, is Flagstaff as a whole, is it kind of filling that same balance?
Clearly the sub 700 is still the most active, and then the luxury price point of probably 1.1 and above is pretty hot.
Kind of interesting, huh?
Yeah.
Yeah.
So
it's good to have money to throw around.
Right, of course. And then the hardest price point is still that 750 to $1 million or so.
Okay.
But if you have an awesome house or a house in a great location, you can, definitely get reasonable offers in a reasonable amount of time. Overall, we're at about 89 days on market right now.
Yeah.
Which has started increasing slightly again, which I think is just another sign that we've reached the peak of season, and there's going to be probably fewer sellers, getting their house ready for the market.
Yeah.
And buyers will continue, probably, snatching up some of that inventory as we head towards the end of the year.
Would you say that it's kind of like a logic is prevailing? And just hearing you talk about it, that kind of came to mind here. Is it's kind of like, hey, you have a decent house, great. You have a rougher condition, might need to address it or might need to price accordingly. And these things, like as I say them, that seems very logical, but logic's been out the window, or kind of got thrown, or not kind of, that got hardcore thrown out the window for a couple of years there. So we're kind of coming back into this like, all right, if there's 10 houses listed, because all of a sudden that's just what's happened on your street, you might have to be more competitive. If you're the only thing listed in a fairly desirable neighborhood, you can be less competitive, right? And so,
and I think, when I say in a good location, what I'm noticing is now that there is a reasonable amount of inventory, about 4.5 months, that those homes that are right up against the freeway or major road or with the crazy steep driveways, those types of scenarios, those are really challenging. Yeah. You have to price, I would say, 5 to 8% lower than same house, in a better location or with a better driveway, et cetera. Yeah. So those are the things that I think just naturally happen in a more balanced market. Exactly. And we're not used to a balanced market because it's been 6 years of very hot conditions, and now it's like, okay, back to reality.
Yeah, yeah. How many sellers do you find that do you feel? And I think that's changing like each week, right? Is I feel like, and you're having more of those conversations than I am, but that we're seeing more of a reality, like people coming to market with a better price than like pie in the sky, and that maybe 2-3 months ago, as rates still maintain stubbornness, that there was this really harder like conversation with the seller of like, no, we are not going this. We're seeing some softening and some leveling. Do you feel like most sellers are kind of getting that, or there's a lot of pie in the sky still?
I'd say it's probably on the majority of sellers are getting more realistic about the current market, but there's always going to be some people that think their house is worth more than it is. I mean, that's kind of just the normal conversation where it starts, right? Oh, it's really special to me. I like it because, okay, well, let's talk about what appeals to the broad audience. Yeah. And so, I do think that sellers are getting more realistic, and especially once you get the house on the market and they test a price that they're wanting to test and it doesn't work, then it's like, you ready? Okay, let's get that priced where it should have been to start. And then once you get into that reasonable range that you originally are suggesting, then the activity happens. Yeah.
So you're saying it's not impossible to get back into demand when somebody has a property that's like just not getting the activity because they're priced too high? So like, is that kind of the, is it too late if somebody already priced their house too high for them to get the activity, that they wanted to see? Like, are those price cuts actually getting people in the door?
Absolutely. Okay. And I think there's a danger to letting it sit too long before you make that adjustment. So, you have that kind of 2-week super hot activity when you initially list. Then there's another kind of level of activity in that 3rd and 4th week. And then once you hit 2 or 3 months, you better be acting. You know, if you haven't already, then you need to be adjusting that price to get it realistic, because, you know, you don't want to stigmatize the house by having it sitting 100+ days.
Yeah.
Yeah, I feel like a lot of sellers and buyers are waiting for interest rates to get cut so that they either can sell the house for the price that they want, or the buyer can get the rate that they want. So I'm interested to hear your perspective on.
Yeah. So my kind of just quick take on market right now, as well as we are seeing, it's been an interesting ebb and flow of when we watch national mortgage application data. It's pretty interesting that my own activity here locally moves fairly similar with that, right? And that's been an interesting. You typically see this seasonal of like, all right, spring, summer, there's more people moving, applying for mortgages, ready to buy, and then in your winter season's a little slower. And we kind of saw with, I think, and I would say, and just take this as, some of this is then, it's really just best guesses as we see this mortgage application data change, and we line that up with different events occurring. But, start of the year, we were seeing a pretty optimistic rate environment, election cycles behind us, and heading in, we actually saw in our market, Flagstaff market was up quite a bit in Q1. Year over year was like, so it seemed like we were going to get this really good steam ahead, and then all of a sudden that big April tariff kind of brake pump pushed applications way down. A lot of transactions did, or I didn't say a lot, let's be anecdotal with it here, but some transactions just flat out fell out, right? Because they're like, I don't know what's going on. Yeah. And there was kind of more of a fear reaction from an economic standpoint. And then since then, we kind of seen this level out, and have seen, just as David was saying, we've seen little ebbs and flows, but we are seeing a fairly stable interest rate environment, versus in 2022 and 2023, we saw like anything from, high sixes to mid eights, right? In some of those years. So for us to be like, hey, we've been primarily under 7 majority of the year, maybe just over 7 for a couple of those, big market pushes, but overall, sitting in it, and that's on a primary, 30-year fixed. Right now we're sitting, high sixes, mid high sixes on that 30-year fixed rate. And we are seeing here midsummer. So we did see that kind of tail off right into what we'd think would be the busy season. Mortgage applications were down, but we are seeing kind of that come back. And just like David was saying, is kind of that have to or don't care buyer, right? Of like, all right, I'm moving, I'm relocating here, or we can't live in a 2-bedroom house anymore with the new kid or what on the way, or so, and or a lot of folks that just that do have the means, or we are seeing a lot of, and I'll be we'll bring you into the conversation on these types of strategies as well. We do have a lot of inheritance buyers, right? So we have a lot of folks that have just gotten inheritance, and that allows them to have a bigger punch here in Flagstaff and abilities. So life just happening essentially. So, and a long-winded answer to that is we're seeing a fairly stable market as far as predictions go. Whether head into that now or later, we might as well just jump into it to where I would probably encourage most folks to not hold breath on interest rates for the short term. Right? Don't think that next month something's going to change drastically. I would hope that hopefully we saw last week Fed didn't move funds rate just yet. That has an indirect impact. And so could we see their next meeting would be September, that we see if they decide to do any changes on that, and continue to monitor the jobs and inflation data heading up to that. Would I like to see us get into the low 6s by the end of this year? That's where a lot of predictions currently are. And I'd like to still see that happen, and probably still see further softening on a slow pace into 2026. That's what I'd hope. But with that being said, that still very much leads to we're jumping right into like advice for people here, but but it very much leads to don't wait on the rate, right? Make your buying decision based on market terms when you can find the house that you want, and we can always reassess that rate opportunity. I don't think that you're going to be drastically better off in just waiting a month or two, and you postponing a housing decision for a year is in my mind, you're not going to find a significantly better deal a year from now.
Yeah. Right. I mean, you could easily wait and then in hope of, right? And you might kind of back yourself into waiting for 3 years rather than 3 months, because we can't perfectly predict what the rates are going to do. And then on the same token, you got to remember that the lower the rates go, the more competition you're going to have over those homes in the market. So you're going to be up against more buyers and have less leverage in that conversation.
Yeah.
So,
well, and I think if I have this in my mind right, and correct me if I'm wrong, Matthew, but oftentimes probably when you're talking to someone about when is the right time to buy, like if you're looking at like an individual stock or something, like timing the bottom is near impossible, right?
Right.
And so I would think, so correct me if I'm wrong, there's kind of two decision points to say, okay, if it is going to, if we have a high likelihood and data-backed process of thinking this could significantly get cheaper, let's continue to wait. If we feel like we're starting to get into that balance where we could be hitting that trough, we buy now. Because even if it gets a little lower, and the reason I'm saying this, so like in 2010, we bought our first home, and it did actually get like $10,000 to $15,000. Like homes in the neighborhood were $10,000 to $15,000 cheaper than when we bought. And at first I was like, oh man, I kind of didn't time that right. That's like for 6 months. Right. and then the next 6 to 12 months were like right where we were at.
Yeah, but 10 to 15 years later, look at where you're at.
Yeah. And so that's what I'm saying is unless we were going to be like $50,000 or $60,000 or $70,000, I don't see that happening in our market. Right? Where we're like going to get significantly cheaper on homes. So yeah, sure. The home that you could buy in the winter time or December might be slightly cheaper than the home you buy in August, but that's 6 months more, calculate 6 months more lease, timing of everything, postponing your life. And then are you really ahead in 5 years from now?
yeah, leave the day trading to people that do it for a living.
Yep.
Make housing decisions for your lifestyle.
Yep. So yeah. And then to find like, okay, 12 months from now, you could refinance, or you now have leased for a year and you are buying, and are you really better off then, right? And it's the same deal, it's the same price point, or even maybe higher because rates, it just, I would very much, like you said, I would make the decision based on what you need to do for your life right now and not think that you're going to time this.
Yeah, and one quick thing, sorry, Matt,
okay.
But one quick thing is you've done an awesome job, Chris, at creating those cost of waiting analyses. Yeah. And if anybody is kind of on the fence, if now is the right time, hit up Chris, because he can talk to you about your scenario and give you that, what does this look like 1, 2, 3, 5 years from now? If I did wait instead of purchasing now, because it's really eye-opening when you actually look at the numbers.
Yeah, absolutely. Yeah, I mean, that's why we love having you as well, Matthew, because it's like, when's the best day to invest?
Right. So, yeah, it's an interesting thing that, people kind of consider. They use their emotions to try to make, financial decisions. And it makes sense because money inherently is an emotional decision, right? But when somebody's thinking about getting out of an investment and hoping to buy it again at the bottom, not only do you have to predict the future perfectly once, but actually twice.
Yeah.
Right? And even a weather forecaster meteorologist can't predict the weather today, So it's all about time in the market rather than timing the market, and
time. So say that more clearly, because I understood it, but I don't think everyone understood what he just said.
It's all about time in the market, not timing the market.
Yep. Yeah.
Like
so
that.
Getting in the game. Yep. So yeah, so let's hear your hot take on what's happening then with markets right now. How are they dealing with the inflation data, tariff news, the big, beautiful bill?
Yeah.
We'll hear more big, beautiful bill from Travis too.
Yeah. I mean, there's no shortage of uncertainty in the financial markets right now. Markets are basically at an all-time high.
So there's a lot of good things happening.
Nobody's very excited about it because a lot of investors, my clients, are pretty terrified about what the future might hold. Like they're thrilled that they've seen the recovery since the April low, 15+%. But it's not about today that they're thinking about, or their goals today. They're thinking about, what is this account going to do when this possible thing might happen, right? And
sure.
So it's been difficult just trying to coach folks on making smart financial decisions based off of their goals rather than their emotions, right? So, I finally got a whiteboard in the office and we write, clients' financial goals and we just list them out and then we assign a number to it, right? And if we can accomplish the goals that are independent of the market, right? Like from income being generated by certain investments, right? they feel a lot better about what might happen, and then really they don't have to lose sleep over it. So lots of uncertainty, but the future's still bright.
Yeah, and I think what was fascinating, I think as we were talking too, a lot of folks like to have this mindset is this time's different.
Right.
What do you say to that?
Famous last words.
Because, and it's fascinating too when people are like, oh my gosh, it seems like the right and the left have never been more like further apart, and like this is just terrible, and this this policy is terrible, and this, and I'm not trying to minimize people's life concerns, because policies and there can be massive impact to personal life, so I'm not trying to minimize that. But what the big picture, where you look at it and you're like, in a short 60 years, I mean, let's name it, like the events that we've gone through as a U.S. economy in 60 years, like, I don't know. I definitely don't think we're in World War II scenarios. I don't think we're in like a Vietnam scenario just yet, or the dot-com burst, or the real estate,
Yeah. I mean, something's going to happen, right? Like something always will happen, right?
Yeah.
Like markets will go down at some point. Like that is essentially guaranteed, right? Yeah. And so how are you going to be prepared for that today, right? While the market's at an all-time high?
Yeah.
That's the question you should be asking, and not how do we control something that's completely out of our control? How do we focus on, creating the certainty with our own portfolio, our own income, that takes the market out of the market, so that, you can sleep at night.
Yeah.
So Matthew, with that, how are you coaching people to be proactive, to kind of protect themselves?
Yeah. So, I mean, I have a pretty systematized process by bringing clients in to really identify and prioritize their financial goals, right? So usually the first goal is financial independence, right? The second is being able to sleep at night, knowing that they're going to be okay, right? The third might be, I want to have a lifestyle, right? I want to be able to retire and travel and go to restaurants and afford to do the fun things in life that I've worked hard for. Then really breaking it down to, it's really just a math problem, right? Like, how much income do you need to accomplish each of these things, right? And then the ultimate question is, what investment strategy or strategies can best accomplish those goals while considering your risk tolerance and your other financial situation. So it is a pretty systematized process, but it is unique to each client.
Yeah, absolutely. And so I guess, are you seeing generally a lot of clients feeling more on the defensive than offensive right now?
Absolutely.
Yeah. Which makes sense. So,
yep.
No, I appreciate that.
Which
so
is probably not a bad thing. I mean, if your stock portfolio blew up over the last 5 years, like the S&P 500 did, like it doubled, in the last 5 years, you should probably take some chips off the table,
Sure.
So it's, but you also have to consider the tax consequences of those changes, right? And lots of other factors that is pretty unique to each client.
Which is a perfect segue, I think. So tax consequences in this big, beautiful bill. Is that all people are talking to you about these days, Travis? Are you tired about hearing about that big, beautiful bill?
Oh, it's only just getting started. So, that is a big thing. Obviously, right now, there's these huge tax changes don't come around very often. Um, Funnily enough, it's my second one in my short career already. But here we are. It's hard. I think there's a few things that are going to even go back a couple years that will impact a very small percentage of people, very, very small percentage of people. There's things that we need to be ready for 2025, and then there's things most of it is, well, we're not going to worry about this right now because we've got enough to worry about with 2025, and then we'll face 2026, which is the bulk of the changes are effective 2026, but a lot of good things. I think that there's, and even if it's just for the certainty of knowing that the sunset that was in place is no longer there on a lot of these things, like the QBI deduction, the various things like that are, it's gonna be a good thing for a lot of small businesses. we're, unfortunately right now, a lot of the advice that I give is hold on, wait, I don't know,
Yeah.
because the IRS hasn't come out and said anything yet. But you're right, Chris. This has been a really big talking point, but nothing that was super shocking. It's really, a lot of it is an extension of what's already been in place. So, and then, otherwise, other than the one big beautiful bill, HR1, just continuing to see people that have, whether it's a one-time, complex issue, like a trustee of a trust, or a personal representative on an estate. A lot of people that just don't really know where to turn to, that we're trying to help out. Businesses that are trying to get one solution for their bookkeeping and their tax and their advisory services, all, and those people are out there. And we're one of the few in town that have the capacity and the ability to do it. So, it's but there's, lots going on, lots of people that are doing well, lots of people that don't know if they're doing well or not, because they don't have they don't have good records and stuff like that. But, so those have been some of the big things that have come up lately. But yeah, certainly one big beautiful bill, and we'll just kind of see what the guidance is here in the coming months.
So would you say and you're the pro here, and I've only really surfaced kind of reviewed, especially more so the impact to real estate. What, as best you can just guess here, what percentage of it was more so just an extension and a keeping the status quo versus new shifts that are going to be or require a significant amount of positioning?
Yeah, I think that the big things, were primarily an extension. The QBI deduction, that's huge. It's a huge deduction for people, and that's extended, and it's permanent. It's not going to sunset, like it was set to in the last bill. So, and then the other big one that is more or less an extension is the gift and estate exclusion, $50 million or so, and then index for inflation moving forward. So those are some big ones. The other really big one is bonus depreciation. So if you're a construction contractor, I hope you didn't buy any equipment on January 2nd. I hope that you waited until a little later, because there's some unique rules there with, I'm sure it was all budget related. But anyway, it's, there's, that's probably the biggest change, Chris, as far as, that what was in 2024, versus what is now in 2025, is the bonus depreciation being back to 100%. So, there's so much to digest in there. There's going to be new information that comes out every week that we'll have our finger on the pulse of, and it's just beginning. To give a percentage, it's hard to say, because there is some significant changes. How much that will impact everybody, our clients, I don't know. But certainly the bonus depreciation and QBI is massive, and that's going to impact a lot of people.
Definitely. Well, and I did see, and one of the things we wanted to talk about, especially today, is that they didn't make any changes to capital gains, right?
Yeah, that's my understanding.
And let's explain that. So a lot of folks don't actually understand capital gains and taxation and real estate sales, whether it's primary or investment or secondary. Can you give us a nutshell definition of what capital gains are when it comes to real estate?
Absolutely. So, I mean, basically, you buy a property at $100,000. Market goes up to $200,000 and you sell it. You've got to pay tax on $100,000. And there's some nuance there, but basically there's tax if as your assets appreciate and you sell them, there is a taxable event that is triggered by that. So,
And does that
some
change the so talk to us then on the tax bracket, and then some exceptions. We'll talk about the nuances and exceptions as well, because it's quite a bit to unpack. But does that then get taxed at a different rate, or does that just change your
Ordinary income.
Yeah, ordinary income.
How nerdy do you want me to get here, Chris? I mean, we can go all day here.
That's giving a thumbs
with
up.
details,
he wants
but
you to nerd out.
but you're spot on. You're spot on. So it, for the most part, real estate you're holding on to for more than 1 year, and so that is taxed at a different rate, and well, most likely a different rate, and it can be pretty significant. And the top tax rate for long-term capital gains is 20% versus almost 40% if it's ordinary. So big differences there.
So like fix and flippers are looking at different gains rates, right? That's
certainly
the type of person that's going to be selling in a quick. Your normal purchaser. Still though, even someone, the vast majority of folks, we can talk about investors maybe in a minute, but vast majority of folks are buying as a primary, but still can incur capital gains, even with the long-term hold, like you said, 20% there. And then there are some exceptions, right?
Yeah, absolutely. So, personal, if it's your personal residence, there's some exclusions there that are available, and then some ways to get creative if it's not your personal residence. And we'll talk a little bit more about that. Some exchange opportunities to get real excited about some 1031 exchanges.
Yeah, and so we just for everyone listening, we've taken this to like nerd level 10, and we're gonna stay there. So for folks,
you did ask me to start talking, so that's what I bring to the table here.
Yeah, no, I love it, and so that's where I think it's what we have to realize is that the level when, back in the day when grandpa was buying real estate and they bought $70,000 home, and because wasn't the original capital gains law was in like the 90s, right? Or 80s?
No, don't test my
I just saw this. So Chris. Yeah, we should someone put it in the comments below. So this has been around, and these limits have been around for a long, long time, which is crazy because then all of a sudden fast forward to 2025, and your average sales price in Flagstaff is in the $600,000 to $700,000 range, and we've seen even the last decade over 30 to 40% appreciation in just 10 years. So capital gains is actually this needs to become everyone's vocabulary, even as a primary owner.
Yeah, and especially if they're claiming this bonus depreciation Travis was talking about, right? By depreciating that basis even lower, if they go to sell it at that that gain, they not only owe the capital gain on the part he was talking about, but Travis, correct me if I'm wrong, you have to repay the tax benefit that you got by claiming that depreciation before, right? And I think that's called depreciation.
Speaking to investment properties, right?
Yes, speaking investment properties.
Is that right, Travis?
Yep, you got it.
So basically from primary to investment to secondary, everyone needs to be aware of these gains and situations. And I think especially when we see, I wish I had these stats in front of me. I've looked these all up. They're part of my reverse mortgage presentation when the boomer generation, our boomer friends, they own 40% of the real estate in the country, and it's in the trillions of dollars. And so when we look at, from a standpoint of what are you going to do with the home? Did you move out? Are you in a retirement home already? Do you own a couple rental properties? How are we managing this and not just paying out a ton of asset to the government, right?
Yeah. And so give the government a tip.
Yeah, pay your fair share, but nothing more. And so let's talk about that. So if let's put it in the two veins here, and let's kind of run through this as efficiently as we can here. So if a primary individual, and we're not giving people tax advice here, but if a primary individual is selling a home, they need to talk to Travis. Give Travis a call before you list with David. Travis
is at Stevens & Company.
Yep.
Downtown?
Contact
Thanks,
information below. And so, yeah, you need to be able to assess, okay, what, don't ask me and don't ask David. We are smart people, but don't ask me what I'm not a professional in. I will not give you tax advice. And
we can give tax education though, right?
Call Travis.
Okay.
Yes. That's exactly what I'm going to say. Because there's so much to the rules in your personal tax liability. Like, well, say capital gains exists, you need to then talk to a professional. But but what I'd say on that is then investment. So that's more on the primary side of things. Figure out how that could impact your proceeds that you sell before you go buy the next one with David. Right? We're going to want to talk through this. As far as investor, I want to kind of turn that over to then Matthew and Travis. Talk us through what, and a lot of people maybe have heard about these, but you have a particular product as well as then understanding a 1031 and different avenues with that.
Yeah, I think the great place to start, sorry, Travis, would be actually if you could share what a 1031 is just from a layman's perspective.
Yeah, absolutely. So, and I just want to echo what Chris and David have said there, that it's, come go talk to your tax advisor. And if you don't have one, come talk to me or someone else that you trust, because these are things we get. There's a couple of those triggers that we see where someone, we're going to tell someone they owe $100,000 and they had no idea. Because they didn't come and they didn't talk to anybody beforehand. Those are not easy phone calls for me. It's not easy phone calls for them. And a lot of times they've already put that money into another house. So talk to your tax professional. If you're investing in real estate, if you're looking to sell, make sure that you talk to somebody.
Yeah, or vice versa. I would say too. Sorry, real quick, as I've had someone tell me, my uncle said I'm going to owe all this tax. And no, talk to a professional. You might find that because of certain exemptions and your exact ownership of the house, that it's not that. So yeah, talk to a professional. Yeah. Mm-hmm. Sorry. Go ahead, Travis.
Yeah, no, you're good. So 1031 exchange is that it's an opportunity in the law. It's got to be there's for the most part an investment property. So it's not a personal use property, but a rental property, or maybe you just own some land that you just hold on for investment purposes. And if done correctly, you can sell that property, have and identify a new property, and defer some or all of the gain that you would have recognized on that property, and push it down the road later. So it can be it is kicking the can down the street, certainly. I mean, that's you're not avoiding taxes completely, but it's a real thing. It's a good planning opportunity to put you in control as far as when you're going to have that gain recognized. They're tricky. There's a lot of rules, and you gotta make sure that you're doing it correctly. But the gist of it is you're taking an investment property, you find another investment property, and you're deferring the gain into the new property. So that's at high level. That's kind of a 1031 exchange.
I mean, the value of that obviously is you're snowballing, right? You don't have to pay the tax on those gains right away. You can just snowball that into something for longer term, and defer to different tax strategy down the road, or investment strategy down the road. And obviously, David and I would be happy to connect folks with 1031 exchange companies and talk people through that process. So if you are an investor thinking to sell, and getting back into real estate, definitely avenues that Travis, me, and David can help you with. But if they're not really excited to throw it back in real estate, here comes Matthew with this amazing solution that's very nuanced, because not everyone thinks, okay, I want to go, I'm going to sell the primary property. I'm going to buy a duplex. I'm going to Robert Kiyosaki this into an 11 unit apartment. And all of a sudden I own, a high rise on Miami Strip, and they were just rolling this 1031, right? That's kind of a classic thought process of the use of a 1031, but there's also some different avenues on that. Talk to us through that product.
Yeah. So, before I get into the product, I'd like to kind of take a lay of the land, right?
Yes,
so,
please.
What do investment property investors expect out of their investment property?
They expect a return, both appreciation and rents, but they also have to keep up with maintenance and tenants and all these other things. am I setting the stage?
Perfect. No, you're spot on. Just because, I think you're a real estate investor.
Yeah.
I'm a real estate investor.
Yeah.
And I've had my fair share of struggles and frustrations when it comes to managing and investing in physical real estate.
Yeah.
Right. Most folks are familiar with a 1031, especially if they are an investor, but many only consider that another property, a like-kind property, is their only avenue to go.
Yeah.
But I'm here to share a concept about, it's not necessarily a product, but it's a strategy of, a different alternative to getting back into another piece of physical real estate, because everybody's situations are different, but maybe somebody wants to get out of that physical real estate responsibility and actually just retire and live on the passive income. So this is a strategy called a Delaware statutory trust. This was a entity that's created in the state of Delaware that was set up by the laws there that allow an investor to 1031 the proceeds of their investment property into a pool of real estate, commercial and residential real estate, that allows them to continue deferring those capital gains, especially if they're done correctly. Well, only if they're done correctly, like you guys were talking about.
Yeah.
Into a fund that actually has interest in this physical real estate, like multifamily housing, medical complexes, industrial warehouses, student housing, all sorts of different types of kind of cool commercial real estate that provides that passive monthly income that the investor is looking for. And especially if they get to defer that capital gain, I'm working with a client right now. They're selling a commercial property for $1.8 million, and their tax bill right now is over $500K, right? And by them choosing, or at least exploring, this option as an alternative, because they're retired. One's 82, the other one's in their 60s, and they're done with the physical real estate. It's just a great option for a temporary solution to get out of that highly appreciated property and then control the taxes on the back end.
Yeah.
There's more nuance to it, but that's a highlight.
Definitely. And so would you say, so this is, would you say, let's talk through the profile client that should be interested in this. So like we said, the addicted to real estate investor, this is not for. You're going to talk to David and you're going to say, we're going to invest in another and another and another, and we're going to roll this bigger or invest.
And you'll get your mortgage through Chris Hallows.
Yeah, thanks, man. And so, and so
You'll leverage it through Chris Hallows.
Yeah. And so, yeah, if you're thinking, hey, it's time to re-diversify, put my property, I'm going to sell my real estate and buy two or re-diversify that, go from long-term to short-term or whatever. Great that you're just going to do a fairly straightforward 1031 exchange on that. But if you are thinking, hey, I'm tired, I'm getting tired of the real estate, or I have other plans, but I want to keep that equity growing, but not have to worry about taxable event. Mm-hmm. That's that ideal client, right?
Yeah. I mean, there's a lot of details, but generally somebody with at least 500,000 in equity, somebody that hires a qualified intermediary to make sure that this is done correctly.
Yeah.
Probably like retiree type age makes a lot of sense because, or it could be other people too, but generally a retiree just wants to have that income and not, the responsibility of that physical real estate.
Because let's talk through, and actually, sorry.
No, go ahead.
Well, and even just to give a case study idea. Uh-huh. So, and I feel like, and if you're, please folks, if you're hearing this, like forward this to folks that that could be in this situation. So you have someone like retiring situation. They're like, all right, I'm good. I have my good in the sense of my budget squared away. I don't need this producing, anything necessary to me. Maybe it's part of the legacy plan.
Right.
But the maintenance costs, the logistics of that, not something you want to care about in retirement too.
Right.
And so this isn't like the sole case basis, but I think a lot about this in the sense of, like you said, that kind of retirement, you're sitting on the real estate and you said, hey, not sure where real estate's going. We've had a lot of acceleration on the appreciation. Right. Maybe it's kind of a slower next 5 years. Maybe it's time to take the chips off the table, not worry about a roof, appliances, maintenance, the yard, and get this into a real estate fund where you have then not created a taxable event And then if that just becomes part of that legacy plan,
Yep, exactly.
and then all of a sudden, you
What happens when
pass along to
you
the
pass
greener
away?
pastures,
Right.
and then all of a sudden, what happens when you pass that over to kids? Travis, what happens if I have then $1 million of appreciation on this property? If I was taxed on that, I'd be paying capital gains if I withdrew those funds. But if I pass it on to my heirs, what happens? If it's in a real estate fund?
Well, for the most part, any depreciation is going to go away, and the appreciation is just going to go straight to the kids. No tax for the most part.
Yep.
So they would obtain the real estate at a stepped up basis.
Right.
So I think one thing that we haven't clarified that some people would find useful is that, you're exchanging like kind,
Yes.
right?
Yeah, you can't just go by stocks.
Right. So people think, oh, if I'm selling a house, I have to buy a house. If I'm selling a fourplex, I've got to go buy, multifamily or land for land, right?
Yep.
But it's a pretty loose definition of like for like. Is that right, Travis?
It needs to be again, for the most part, there's a couple of options that aren't real estate specific, but it has to be an investment property for an investment property.
Okay, so it could be land,
And your
duplex.
Porsche is not an investment property.
Right.
Investment real estate.
Yeah, the Overland Expo, they might argue with some of their vehicles, but
Yeah.
But then with Matt's product, it is still considered real estate, but it's a fractional share. It's a group of investors you're buying in to be part of this group. Is that right?
Yep.
Okay. Can you explain that a little bit more so people see the idea of what this investment looks like?
Yeah, so it's a fund, right? So it's like a swimming pool of various, commercial real estate, like those examples I shared. So multiple properties, multiple owners. There's a lifeguard on the edge who's the portfolio manager, okay, who professionally manages and leases out and hires the tenant, finds the tenants, hires the cleaners, and mails you the check, most importantly, who takes care of that fund or that pool of investments that you have fractional ownership. So thank you for clarifying that. But the great thing is that after a 2-year period, after a 1031, the client has liquidity options to where they can choose if and how much capital gain they want to realize. So rather than just outright selling a property, realizing all that capital gain and depreciation all in 1 year, working with somebody like Travis and myself, we could strategize the most efficient way of how much to split off and then continue to re-diversify or, please spend your money. But, if
There might be smarter ways to take on that tax consequence by not cashing out your full investment at once.
Exactly. Yep.
Yeah.
That's
Sorry, go ahead, Travis.
that's one thing I like. 1031s they're great in certain situations, but it really is just kicking the can down the street, because when you sell real estate, you're selling all of it. And if you're finally done kicking the can down the street and you're done with real estate, you've got to pay the tax. Where this is an opportunity to really take advantage of slicing off the tax burden. So rather than having $500,000 in 1 year, we're able to and having that tax a little higher rates, we're able to slice that off and choose what we want to do. And it's, at least that's my understanding of how these work, Matt, but correct me if I'm wrong there.
Nope, you're spot on. So just being strategic about slicing off, enough to make sense, right? To continue to diversify or not, or just continue to own that Delaware statutory trust. I'm just going to name drop them again so people can do their research, but, own that through death, where your heirs or your spouse can potentially receive that step up in basis, and all that gain just gets wiped away.
Which then is kind of fascinating in the sense of like, all right, you have that classic scenario, and we're seeing again more and more of this, of like, all right, grandma's gone, we got the house. Who wants the house? What are you going to do with the house? Now we got to find a realtor to sell the house. What's the fair market value for the house? And uncle wants to sell the house super high and everyone else just wants their money. And, so it's like, okay, maybe not a bad idea of don't let anyone get a house. Let them get a fund.
Right. Shares of a fund that they can choose to take their portion and do whatever they want.
You don't have, as great as David is at listing properties, you don't have to worry about a list agreement, the timing exposure on market.
Well, you do. You just do it earlier and then get the fund.
Yeah, exactly. Sell with David now. No. So anyway, I think, so obviously we got like super, super in the weeds with some of that, but I think it's fascinating. I hope a lot of folks that this applies to enjoyed that little extra depth of detail. Because I would really say, in summarizing, yes, markets are different, tighter. The available cash that we saw in like 2020 through 2022, that's just getting thrown around. Like now we have to be smart and to say, okay, you got a lot of equity in that house. You want to move up. You have different goals. You want to change your investment strategy. You were one of those folks that thought Airbnb was going to make you a gazillionaire and it's didn't. And you're holding on to that property in like this sunk cost mindset. Look up sunk cost. It's one of my favorite economic principles. I teach my kids about it every day.
That's very good.
Yeah.
I'm feeling that now.
Yeah. But to say, okay, but you have options and it's not just like, okay, we're going to sell it and take this big hit and like, just this. No. I think it's so for folks, I think right now in this economy, it's a matter of you got to be smart and there's so much opportunity, but you just have to, don't YouTube your financial advice. Definitely don't TikTok it. But get with professionals and be smart because little moves can have giant trajectory changes for you right now.
Well summarized, Chris.
Oh, so anything else that anyone, we've been going a hot minute here. So and appreciate all your expertise, everyone here on the table and Travis here virtually. Hope you get feeling better, Travis. But any other last minute pieces that people want to throw down today in conclusions?
Not me.
No, I just think this is a super creative way to have something that's so much lower maintenance and that's awesome. I mean, it's like you're getting rid of the ranch and getting a condo. Yeah, in the maintenance sense, right?
Right. Yeah. So. No, it's really passive income in the truest sense of the word.
And definitely, we'll have Matthew's contact below for holistic. As far as like talking through what that can actually gain. It's not just because we talked a lot about what it can save, but what it can gain as well, and how that works out into your overall financial portfolio. Again, don't call me or don't call David. Call Matthew when it comes to your financial advice. Or for your financial portfolio and growth. I do debt. David does homes. All right. So thanks everyone for tuning in. Thanks, boys. And look forward to the next quarter.
Awesome, guys. Thanks for having us, Chris.